There's a lot of excitement.
Hey, Lou, I have a question. Maybe you're familiar with it, or anybody.
Yeah, go for it, buddy.
Anyone ever deal with a corporate lease or rental?
Okay, what's your question around the corporate lease?
Corporate lease? Well, should I go with it?
Oh, you mean should you accept a tenant for a corporate lease?
Yeah, they say that the lease gonna be on the company name. They will clean the place like once a month. I mean, it seems to be beautiful, but I'm not sure if something I've never done this one. You know.
Well, a corporate lease is fine because I remember when I leased all of my places, I've always been under a corporate entity, but there still has to be a person that is responsible for the corporation that is going to give a personal guarantee in case something doesn't go right. Obviously have an attorney review any commercial lease. You should always have your attorney review that way and make sure that you don't have any potential pitfalls that you can be facing as a landlord. I would rather take a corporate lease than a residential lease because a residential lease it's really difficult to get people evicted. But a corporate lease is a little bit easier to get someone out if they're not paying.
Okay.
I have
Yeah, I would
input.
definitely.
It depends
for it.
on where it's at too. If your place is at a place that has a lot of visitors, what Airbnbers are doing also is that they are doing corporate leases. That's the way how they get into a lot of apartment complexes to do Airbnbs.
So they're
Okay.
they're using the corporate lease strategy in order to be able to sublease.
Yes. Yes,
Interesting.
that's why they're able to turn beds so fast. So that's what
Now,
they're doing.
Are they doing that with the owner's blessing, or are they doing that with like creative language that they're doing without the owner being privy of it?
Both.
Oh, both. Okay.
Both, yeah. So that's why Atlanta, now there's a rule that you can only have 2 corporate leases. They're trying to tax the whole thing. So, corporate lease, the Atlanta area is cracking down on corporate leasing
I can imagine.
because of the Airbnb business.
Oh, wow.
Has anyone seen Airbnbs quieting down or maybe like not being as popular anymore?
Yeah.
You guys are seeing the whole like, I guess, excitement of it kind of wearing off?
I see a lot of news articles on how it's quieted down and it's tapering off a lot.
Okay. Yeah, I'm hearing a mixed bag because here in Southwest Florida, I'm seeing more short-term rental homes hit the market, which is for sale, which is kind of like, oh, why are they selling it if it's a cash cow? Especially right now going into winter, this is our busiest time of the year. You would think, why would someone want to sell it? Well, obviously, some of them were damaged with the hurricane, but some of them weren't. So, which kind of lead me to believe, hey, is there like a quieting down of this Airbnb thing because I'm seeing more inventory out there? And then I spoke to one of my friends here he's a professional Airbnb guy. That's all he does. He even gives talks on Airbnb at like conferences. And he was telling me that he just rented his place for 28 days or 28 nights, I guess you could call it, for 25 grand. So he said he's still getting a ton of money for his Airbnb. So he said he doesn't see any quieting down at all. But I guess it just depends. It's probably very hyper local and very super like niche markets. So I guess people who are trying it out maybe for the first time ever, or maybe in an area that's sketchy or 50-50, maybe those are the first ones to go.
Well, I think what we're seeing too is a lot of HOAs are limiting those leases under 30 days or whatever their rules are.
Yeah, that's one of the biggest struggles with Airbnbs is that you can't do it you can't fly under the radar of an HOA. I tried that in Jersey and I found out the hard way. I had an Airbnb that was doing great, and then come to find out the HOA didn't allow it. And then here in Florida, here in Naples specifically, there are only 2 HOAs in the whole city that allow you to actually have a robust Airbnb business. One that my buddy has a house in, and the other one, luckily enough, I didn't even know this, but I bought a condo in the other one that allows you to have 12 rentals a year, which would allow you to do like a pretty good Airbnb rental there. But every other HOA, no, they are like 3 rentals max a year. Like you wouldn't be able to really do an Airbnb business with that. Some of them don't allow you to rent it at all for the first 2 years, not even if it's a long-term tenant. So yeah, HOAs. If you guys are looking, have a client that is looking for Airbnb stuff, stay away from HOAs. That's rough. Yeah. All right, good. All right, so if you guys don't have anything else to share, let's go ahead and talk about some of the trending topics that we have for this week. So last week we got the housing starts numbers, and we got the permits and all the completion numbers from the Bureau of Labor Statistics, which is basically where we get our information from, where the housing supply is going to be in the future. So from what I saw, and I'll share it with you guys in just a moment. From what I saw, builders are tapering off on starting homes, but the problem is that a lot of them are already too far deep. They're already in the construction phase. So you can see the curve start to kind of flatten, but the problem is that in order for builders to slow down and pump the brakes, it takes them a while. It doesn't just happen overnight, because put yourself in a position of a builder. Maybe you guys have renovated a home before, if you guys have even had a client that's renovated home, it could take up to like 6 months to a year to either renovate or build a new property. So a couple of months ago is when we really started to see like the bad news start to hit the fan, and things started to get weird. So builders have been slowing down, and then most recently, a lot of them have just like walked away from deposits and pumped the brakes really hard. But the inventory that's in the pipeline, they have to finish that off. So you're starting to see that curve starting to flatten off and actually start to turn back down. But the problem with that is that you're seeing buyers walk away from the market at a much quicker pace than you're seeing home builders stop building. So what that means is that if we continue on this same kind of path with both statistics falling as quickly as they are, we're going to have definitely more oversupply than we're going to have interested buying parties, because the buying parties, they're dropping off like flies. Just recently, I think I told you guys last week, we had over a 40% drop in mortgage applications. Okay. And right now we're seeing homes that are being completed drop just very small, maybe to the extent of maybe 5 or 6%. They're dropping very slowly. So homeowners are home buyers are walking away much quicker than inventory is hitting the market. So within a few months from now, 6 months from now, a year from now, we're going to have a pretty massive oversupply of new construction, which is going to hit the market pretty hard. Because let's just say that let's just talk in random numbers. Let's just say there's 1 million people that are looking for homes, and then we have 1.5 million or 2 million properties on inventory. The problem is that those new homes are going to hit the market, and they're going to get less money for those homes. So those homes are going to have to come down in price because there's way too many options and way too much stagnant inventory. But the thing is that it doesn't just affect new construction prices, it also affects the prices of existing homes. Because if you're a buyer and you're looking to buy either an existing home or a new home, and you can buy you can buy a new home for not that much more than you can buy an existing home, because the home builders are giving away incentives and they're trying to break even, just get stuff off the inventory. You're going to see a lot more people maybe sway in that direction and buy the new home, which means that existing home inventory may start to also come down in price because of oversupply. So what I'm seeing is, if we continue to move on this path, is we're going to go into 2023 with still seeing much more downward pressure on home prices. Did anyone get a chance to see that report last week, or did you guys hear the news last week about the home prices and the builders numbers and all that?
I didn't.
No, you guys didn't? Okay. Another thing too. I'm sorry, somebody said something? Okay. Another thing too I want to share with you guys. Let me share the screen real quick and show you this. A couple articles that came out last week. They were very interesting. Here, some home buyers lose deposits of 10, 20,000 or more due to high mortgage rates. According to this article, what they're saying here is that because a lot of people were getting into homes when interest rates were a lot cheaper, and now being hit with a much higher interest rate, people are being scared. And I want to tell you guys something. I don't know if you guys have experienced this or came to this realization yet, but for a person to buy a home for the very first time, there's a very big mixed bag of emotions there. there's the initial excitement, right? But excitement and fear are very closely correlated. I don't know if you guys have ever heard, but excitement and fear are almost like this. It's almost like the same neurons go off in your brain. It's the same part of the brain that gets excited. So it's very easy to switch from one to the other. Case in point, when somebody wins a bid on their home and they paid 50 grand over, they get so excited. Oh my God, we won. Oh my God, we won. Oh my God, I can't believe we won. So we paid 50 grand more. Are we gonna be able to afford this? Like, it quickly goes from one side to the other. So what we're seeing here is that buyers are walking away from huge deposits because their initial excitement of being homeowners quickly changes when they see the interest rates that were maybe at 1.3 or 4%. Now they're looking at 6 and 7s, and maybe somebody in their camp is not smart enough or maybe not versed well enough to tell them, hey, listen, there's options to buy your rate down for the next few years. And these people are walking away from a lot of these properties. So from what that tells me is that maybe this is not like a long-term trend or anything, but these homes that are coming back on market, what happens with properties that have been on the market for, I don't know, but for 60, 90 days, and then they come back as a back on market property, what do you think that signals to the market? Oh, look, these sellers are desperate. These sellers are they got their back to the walls. So then that means that people come with more lowball offers, and this starts to become like a whole like a spiral, a death spiral for housing prices, which is never a good thing to see, especially in a market where we're seeing so much more inventory and higher interest rates with homes coming back on the market. It's never a good situation. Have you guys been seeing this on your end where people are walking away from their deposits, or maybe, well, I know New Jersey, it's very hard to lose your deposit. And in some states like Florida, you'll lose your deposit, like no questions asked. Texas is the same. I'm not sure about
Georgia's the
Oklahoma
same.
or Georgia. Georgia's the same.
Georgia's the
Yeah,
same.
New Jersey's very spoiled. Like I don't think I've ever had a client lose their deposit except for one client who didn't lose their deposit's still in an escrow account somewhere because the two attorneys couldn't come to an agreement. So it's still sitting there probably 15 years later, probably still there. But I've never seen a buyer lose their deposit in Jersey, but in other states, it's very common for a buyer to lose their deposit. So just be conscious of that, because if your buyers are walking into a deal, make sure they know what they're getting into, especially if you're one of those states. You guys seeing that? Have you guys seen buyers walking away from deals because of interest rates or a factor of any other reasons, losing jobs?
I'm not seeing that here. Actually, I'm seeing a lot of the sellers, especially builders, being really proactive and offering the buy downs and offering closing costs. They're really the sellers are very proactive because they want to get rid of their inventory. But I don't see people walking away from their deposit. Not here.
Good. Anywhere else?
In my
Anybody
experience,
else?
anyway.
I had a buyer kill a deal in attorney review. We were almost out of attorney review. And they called me and they said they wanted to kill the deal because of the interest rates.
The interest rates?
Yeah, I watched your last video on YouTube about affordability, and that was it. You know, they did their math, and they just felt like when we started looking for a house, the mortgage was gonna be one price, and then by the time the interest rate, what it is 2 weeks ago, they just felt like the mortgage payment was going to be not affordable anymore.
Let's take a look at the 30-year mortgage rates today and see what we got.
It
So
went
today-
down. It went down from 2 weeks ago.
Yeah.
What
What
I
do you guys think?
experienced with the new constructions, they have rate locks incentives. So when the interest rates was rising, one of my clients, we was just looking at regular residential home, but being that I'm on a list and they was sending me all the incentives of the rate locks, but the mortgage rates was about the mortgage, monthly mortgage was around the same, being that they had the rate lock. So it made more sense for her just to go into new construction.
Yeah, it does. That's what I'm
Yeah,
saying. This new construction stuff is going to be, because they think more like business people, the builders, but a homeowner doesn't come up with the same creative strategies. Maybe the real estate agents, maybe should do their homework. That's why we're having these classes, so that way you take a listing, you can come up with the same kind of a solution. So you were saying, Tammy, continue.
I was saying they had rate locks. Where, if you get under contract at a certain time, they can lock you in on a certain rate.
Yeah.
But my client was the rates was constantly rising, and the mortgage payment was around the same price of their rate locks. So she was able to afford a little bit more because of the rate locks. And she was able to get in her home, because with the new construction, you say you want it, you get in a down payment, is yours. It's no highest and best. And she kept getting outbidded with the highest and best. So we decided to go that route, and she just closed on her house.
Okay. That's good. I mean, that's a good way to do it. I mean, you guys have to get creative in these scenarios. I think it was that video that you're talking about, Sarah. Somebody mentioned in the bottom. I'm sorry, somebody mentioned in the comments that, oh, and you know, if you guys want, I'll play that video for you guys so you know what I'm talking about.
Yeah,
But
yeah, do it.
yeah, there's a scenario in which home buyer goes into a situation where they get approved for a home in late 2021. They can't get a home because everybody's in the bidding war frenzy. But then he finally gets a home in 2022 that's, I think it was $60,000 cheaper. So he's excited. He's like, "Oh my God, I got a home $60,000 cheaper, and I'm gonna end up, you know, paying less now." Then he goes to his mortgage broker, and his mortgage broker says, "You're gonna be paying like $500 more." He said, "What? How's that possible?" He's like, "You can't even qualify for the house anymore." So the guy gets, you know, obviously doesn't get the house, but what options I know Tammy has mentioned, I think a few other people have mentioned here, is the mortgage rate buy downs, right? The mortgage rate buy downs. And I just quickly did this search right here on how discount points can affect your mortgage payment and your rate. So for a lot of you guys who don't know what this is, you guys ever heard, if you've been in the business long enough, um, they're called points. I know they used to be called, people just label them as points. So during the 2000, 2007, 2008 market, mortgage brokers used to charge people points just so they can put that money in their pocket. Points or discount points are not meant for that. What they're meant for is for a client who is at a $2,100 payment and they need to be at a $2,000 payment in order to qualify. And then in order to bring them down to a $2,000 payment, what you do is you pay discount points, and then discount points will lower the rate because you're prepaying that interest by paying those points at closing. So you're giving the bank prepaid interest in the beginning so they can give you a lower rate, and then that brings down your mortgage payment. But in 2007, 2008, in the whole era, mortgage brokers were just charging that just because there's a certain amount that they wanted to make on each deal. And I'm going to be honest with you, I was one of them because I didn't know any better. That's the way I was taught. That's the way we were taught back in the day. It was just like, okay, well, we make 3 points on a deal. We make 4 points on a deal. Oh my God, I made 5 points on that deal. And it was never about like, hey, let's bring it down so the buyer could qualify. Maybe 1 out of every 10 deals, we would do that. But the majority of the time, it was just that. So points got a very dirty name for a long time after the crash, to the point where if anybody were to look at a good faith estimate, or what people call now a closing disclosure, if you look at a closing disclosure, it shows if you see anything that says discount points or origination fee, then you're like, what is this? Why are you charging me? This is like junk fee. These are called junk fees. And people, they got a very dirty rap. So now points are making a comeback. They're making a way back into the normal market, because now people are using them to buy down their actual interest rates instead of the money being taken to a loan officer who can put it in the money in their pocket. So why I'm telling you this is because now people who have been around for a long time, they're seeing discount points, they're making a comeback. They may have a negative connotation to it, but in actuality, they're probably being used now for the purpose that they were intended to be used for, which is to actually service the buyer, to help the buyer. So let's take a look at this real quick, and I'll give you guys an example of what that is. So let's just say we have a $500,000 mortgage. Let's say the interest rate right now is 7.5. Right? Because that's as high as it's been recently. Length of mortgage, we're going to do 30 years. And let me see if I can make this a little bigger for you guys. 30 years. Number of points you plan to purchase, let's go with 0. Interest rate if you don't buy points. If you buy points. 7.5. let's go with 6%. And let's just say you pay 2 points. All right, I'm not sure if this is what, okay. So what it's saying here is what's your interest rate going to be if you buy points, and what's your interest rate going to be if you don't buy points? And I put here that you're willing to pay 2 points. Now, 2 points is 2% of the amount of the mortgage. Okay, so if our mortgage amount, not the purchase price, but the amount of the mortgage is 500,000, 2 points of 500,000 is going to be $10,000. Okay, so keep that in mind. You've got other closing costs besides just discount points. So your closing costs in total are probably going to be somewhere between $17,000 to $20,000 with this math that we're doing right here together. Now, if we calculate this, we got $10,000 in points. Amount of each payment if you don't buy points. Okay, so your mortgage payment will be $3,500 if you don't buy points, and it'll be $2,998. So it's $3,500 or $3,000, almost a $500 difference. So this kind of gives you an idea of where you would be and how much it would cost you. So now your analytical brain has to turn on, and you have to say, okay, so if I'm going to save $500, how many years is it going to take my client or myself to make up this $10,000 initial investment? So if you look at $500 every month for a year, that's like $6,000. So after 2 years, you'd be in the positive. It'd probably take you like about 22 months, and then you'd be in the positive. And then this would be a good investment if you plan to live in the home 5 to 7 years. Then it'd probably be a good investment. But guess what? In 5 to 7 years, we may have rates to come down anyway, maybe back into the 3s and 4s, and you could refinance. So, you know, that you have to think about all those things ahead of time. But if your client needs it in order to be able to afford it, you know, that's a good way to do it. And the beauty of this is that you can ask the seller for the $10,000. You can ask the seller for a concession, because for the last few years, some of you, if you just got into the market, you probably never heard of a seller concession. As a matter of fact, I just had one of my agents who's been in the business 3-4 years. She called me yesterday on a seller concession question because it's been so long since she's done a seller concession. So $10,000, this is not a lot of money. You can ask the seller to kick this in and help the buyer afford. Now the moral of the story is that in the video I made recently, somebody said, oh, this is a non-issue. You can just get the seller to kick in $30,000 and then you wouldn't have a problem. Well, not so much, because depending on how much the home price is, and depending on the loan product you're using, the seller is only allowed to kick in 3 to 6% of the loan amount. So for easy numbers, if you're using a conventional loan, you're going to have a 3% cap on seller concession. So 3% of 500,000 is $15,000. So you'd be okay in that scenario. You can get the seller to kick in at least 10K. Your seller's in a much better position. I mean, your buyer's in a much better position. Everyone's happy, right? But if you're in an FHA deal, you can use 6%. So 6% of 500,000, you're like 30 grand. I'm like, oh my God, you could buy it down even more. You could buy it down 3 points. Great, all is good. But the problem is that the scenario I was using in the comparison in my video, which I'm going to show you guys in just a second, I used the national home average, which I think was like 350, 360,000, somewhere in that ballpark. That's the national home price. The guy was saying, hey, you should just tell the seller to kick in 30,000 to buy it on the rate, and then there's no problems. Everyone's happy. But you can't do that. You can't do that because then you're in violation of what these loans allow you to do. If it's an FHA loan, you can use 6% on 350, which is like 20 grand. So you can't do that. You can use 20 grand, but you can't use 30. And if it's a conventional, that's even worse. You're looking at like 10 grand. So you can't just say, oh, I'll use $30,000 and get my client a 3% rate again. That's just not going to happen. It's just not feasible. So you got to keep those numbers in mind when you look at these solutions. What kind of a loan product am I using? I'm using conventional. Okay, I know that I can only use 3% for seller concession. So that means I can only ask for so much. Now, there's another trick up our sleeve that we can use, which is also called, it's a concession, but it doesn't come from the seller. It comes from the loan officer. The loan officer can give a seller a buyer's credit. So a buyer's credit to the buyer from the loan officer doesn't count as a concession from the seller. So in some instances, you may be able to do both. You can pair up both. The loan officer may kick in, who knows, maybe $1,000, $1,500 to help with the rate. The seller kicks in $10,000. Now your buyer's in a much better position. So use these strategies, guys. Use these strategies as a way to get someone away from renting, or a way to get someone that's scared to go buy a house because of high interest rates. Tell them, listen, no, this is the best market to go shopping, because right now you're in control. It's starting to turn into a buyer's market. Let's start looking for your dream home now. Because if we find something, forget about the rates. The higher the rates go, the better for you, because more people are going to be out of market and the sellers are going to have to sell for less money, and they're more willing to give you concessions. They might even cover all of your closing costs. I know builders will do that nowadays. Builders are like, sell the concessions, let's do it. Let's get these homes sold. We got investors we got to pay. There's nothing worse for a builder than to be on phone calls with their investors or their banks or their creditors, talking about, where's the money? When's our return? I just turned on the news. They said the rates are going up again. Builders have oversupply. You know, they're stressed out. They don't, believe me, the last thing a builder wants to do is sit on an empty house. And the problem with these empty homes is that you can't just convert them to rentals, because that's not their model. That's not what their investors signed up for. Unless they have a whole change of plans, they're just sitting on money and burning cash every day. Every single day they're losing money. So any questions on this so far before we jump into the video real quick?
Louis, I have 2 questions.
Yeah.
How do you ask for those points from the seller? Do you put it in the contract, like in the provision?
I always say start the conversation with the real estate agent, because the real estate agent right now is more willing to talk to you than ever before. Before, they would block you if you tried to call them. Now they are like calling you, hey, how'd the showing go? Did your client like it? You know, what's your thoughts? You know, any suggestions? Like now the listing agents are like your best friend. So
True.
call them and start building relationships and say, look, I want to help you get rid of this home. But in order for you to do that, you could understand my buyer right now is spread pretty thin, because when we started looking for a home, the rates were 4%. Now they're 7.5%. So we came up with this creative solution that'll help them not have to have so much of a mortgage payment. Is your seller willing to accept an offer on the home? I know it's listed for $350. We'll give you the $350, but are they willing to kick in $20K for closing costs so we can buy it on the rate? Oh yeah, sure. Let me check with the seller. The agent goes back, talks to the seller, say, look, we got an offer of $330. But the issue is that the buyer wants to offer you $350. They need to buy down the rate so they can afford it. And I'm sure the seller has been hearing the news, and the seller's like, hey, listen, my house has been on the market for 45, 60 days. Something's got to give. Like, what are we going to do here? And that's the only way homes are going to get sold. Well, not all homes. I mean, there's some homes that'll sell no matter what. But a lot of these homes are going to be in a position where they need to negotiate. They need to come up with strategies and solutions that are outside the box. So I feel like if you have a client and you're willing to make some phone calls, you can get them great deals in this market.
Okay. And my second question, I want to take a screenshot. Can you go up? Yeah, thank you.
No problem.
Thank you.
Louis, can you
Yeah, you
hear
got
me?
I can hear you, Tammy.
Yeah, another strategy I just used, because my clients was requesting, I think, 8,000 back in credit when we did the
Yeah.
inspection. So, so the seller was waiting for the appraisal. So what happened is the house ended up over appraising, and what we did was we had it under contract for 365. It appraised for like 375. So we increased, but the seller agreed on 3,500 to give her. So we increased the price to 370. And you know, and she was able to get her $8,000 towards the credit that she wanted.
Okay.
I have a question.
That's another strategy. Huh?
Tammy, were you representing the seller or the buyer?
The buyer.
Hold on. You share how much the house appraised for with the seller?
No, we didn't.
Oh, okay.
They don't know how much, but we just increased it 5,000 more. It appraised for 375, but we just increased it to 370. So they don't know exactly how much it appraised for.
Perfect. Okay, thank you.
Yeah.
That's just about the same deal I just did with Open Door. And I also know that Open Door, if you have buyers and you have Open Door, they overbought. And I know, Louis, you could attest to that. They overbought over the summer. They have a bunch of inventory. So now is an extremely good time because to go after their homes. They will, come down on it. Remember that
Agreed.
the open door homes have new carpet, new paint. A lot of times they did roof work, but they did a lot of stuff that makes the home move in condition.
Exactly. 100%.
Luis, I was just going to say that I like your strategy. I think it makes a lot of sense, and I'm looking at the experience I had with this last deal in Bridgewater. I listed the house for $749, and I sold it for $755, which was above asking. Now the buyer, I'm just looking at how much money the buyer had to put down, because you're looking at high interest rate, and plus that above asking price. So unless you really have disposable income to be able to do that, to be able to afford that monthly payment for the mortgage. And I think that's where now your idea, this strategy comes in, because not everybody will be able to, that has that disposable income to buy, above asking, as well as deal with the high interest rate.
Exactly. What I think everyone should do this week is schedule a call with their loan officers, whoever you guys are using, and come up with a strategy like, hey, listen, what kind of buy down programs do you have available? So that way, when you start working with buyers or sellers, you utilize this strategy. If you're working with a seller, you say, hey, seller, listen, we're going to promote the fact that even though home interest rates right now are 7 to 7.5%, buy this home with a 4% interest rate. Ask me how. Like if you put that in like the agent comments in an MLS, like a seller is willing to provide a buy down option where you have an effective 4% interest rate. Like something like that would make your listing more appealing. If you're working with a buyer, hey, listen, I know that you think that you can only afford XYZ. I've been working with this loan officer now for a while, and he has a strategy in place where we can get you down to a 4% interest rate. We just got to get the sellers to cooperate. So I'll be in charge of finding homes and listings that'll help you with this, and then you be in charge of just get pre-approved by my loan officer, and then you guys can start building some strategic relationships right now in the down market. Because if you do that, guys, if you start bringing more clients to the right loan officers, those loan officers in turn will invest in you. They'll help you with your marketing, or they'll be sending you over clients as well. But right now is the time to find the people who you want to do long-term business with, not the takers, not the ones who, excuse me, not the ones who are, maybe not ethical, or maybe the ones who are maybe just not going to help you in the future. Make sure that you do your research, get maybe some referrals from other people, and work with a loan officer that will wash your hand too. Like they say, like one hand washes the other. I've seen a lot of relationships in the past where it's a one-way street, and I don't want you guys to go into that. So right now, during a down market, is when you really need to build that right team, where you have the right attorney, you have the right title company, you have the right insurance agent, you have the right loan officer, all the right people, and you have a conversation with all of those people, letting them know your expectations. Like, listen, I'm going to send you business exclusively. What I expect in return is for you to always think of me when you have somebody that I can work with. I don't expect you to give me every one of your deals or every one of your leads, but I expect something from time to time, and putting them on, what's that called? Putting them on notice like that will definitely, guys, return multiples. Because when you don't speak up, what they're thinking in their head is, oh, I don't have to give them anything because they keep giving me business anyway. I don't have to nurture that relationship. It's a toxic relationship. If that was a relationship that you were in a marriage or in any kind of like symbiotic relationship with another person, if one person's the giver, the other one's always the taker, sooner or later the giver is like, hey, what's going on here? Like there's no value here for me. So the same thing goes in business, guys. It has to work both ways. And I've seen a lot of agents just give business out because their broker gives business out, or because that's the popular person to do business with. Sometimes it's okay to work with someone who's not the branch manager. Maybe somebody who is just maybe getting their career started, but they're very much a hustler, a go-getter, someone that's a mover and a shaker. So Make sure you invest in those relationships, build with them, maybe take that journey with them, because you don't know. You know, today maybe they're a one-person operation, and maybe in the future it end up being someone big. So make sure your camp is tight. But I don't even know how I got to this topic. But yeah, so come up with a solution with your loan officers on what you can offer your clients, and make sure you guys don't end up having to stick your buyers with traditional 7.5% rates right now, and you don't have to have your sellers just waiting out there in the wind for an offer to come that makes sense. So you gotta start thinking strategically for them.
No, Louis,
Hey, Sophie.
hey, good morning. No, I'm glad that you went to that topic, because I know an agent who says, oh, loan officers don't have to give me anything as long as they get my buyers approved and take care of them. But I'm like, no, it's a two-way street. You cannot always be giving them. And then what? You have to do the advertising. You're like the lioness going out there hunting, and he's like the king waiting there for the food. I'm like, no, you can't do that. So thank you for touching on that subject.
Absolutely. Yeah. As a broker, I never made my agents use one person. If they asked me who I use, I would tell them, but I always encourage everyone, hey, go out there and build your own relationships. And I'm glad Sophie said that, because Sophie also used to work with, you know, when we were working together in the office space, she would explore new relationships. Other agents would explore new relationships. And I always encourage that. And I always gave those people voices at our meetings, because I want everyone to build their team. You know, what works for me doesn't necessarily have to work for you. But it's important for you guys to have those people that are willing to be there with you and go on that trip with you. It's not an easy one as a real estate agent. You guys know that we go through these massive swings and cycles, but with the right people, you guys can, hey, one referral a month, that could make your month, that could pay your mortgage and your car note. So hopefully that works out.
Good morning, guys.
Ivania?
Yeah, hi, good morning. I wanted to
Hey, good
kind
morning,
of put my 2 cents on it. My first year in real estate, you know, you're new and people offer you stuff, but then I suggest that whenever you guys sit with a new loan officer, you do ask what benefits do they have for you, because you do provide value to them. They get paid every time you close a deal. So long story short, my first year, I gave all my clients to a loan officer. And at the end of the year, they actually wanted me to, when it came to EXP, they actually wanted me to leave EXP. They wanted to open up a brokerage and saying that, oh, you know, you have all these clients, let's open up our own brokerage, blah, blah, blah. And in the conversation that we're having, the guy said, you know, we gave this guy 20 clients. And I'm sitting there and I'm like, I gave you everybody and you didn't give me anybody. So yeah, don't do that. Now I work with a lot of people, and I actually have had lenders fire me because they see that I work with other lenders too. But I mean, these lenders not only work with us, right? They have like 100 realtors that they work with. So don't let them fool you like that. Don't beat me.
I agree with you, Ivania.
And they're not scared to tell you that, guys. They're not scared to tell you that they have other agents. But the minute you mention another loan officer, they get all mad.
They do.
Crazy, because they're not married to us, but we're not really married to them. We are all trying to make a living. And
yeah, absolutely. Not
Louis,
a good,
I just
not a
wanted
good
to say
situation.
that. Can you hear me,
Brian.
Louis?
Yes, we can, brother.
Hey,
How are
buddy,
you?
I'm driving back from Georgia right now, so not Belinda. I don't know where you are from here, but I'm somewhere in your state. I just wanted to say thanks, Louis, because this is, as a relatively new agent, this type of practical help to me is like gold. So I was late to the party today trying to get up and running, but I caught most of it. I'll go back and listen to it. But these are exactly the places I'm in right now with 2 clients, and concessions are new to me. So I just wanted to say thanks. That's all. So when a guy in your position, when you're trying to come up with what do I cover in Mastermind today, just for whatever it's worth to you, this is what's really, really super helpful to me. Along with, it's always helpful, but this type of stuff, very practical. I'll go back and use it as soon as I get back today. I'll be talking to my loan officer, and I just want to say thanks, buddy.
No problem, man. Thank you for being here. I'm glad that I can share the experience and the information I've collected over the years. Because if I just keep it bottled in, what good is it, right? I mean, if I could just help one of you or two of you on this call, it makes all the difference in the world to me. Thanks, guys, for being here. Awesome. All right, guys. Well, I'm not going to bore you too much longer with just random facts about real estate. I'll put the video on real quick, and then if you guys have any questions, just let me know as soon as it's over, okay? All right, let me see if I can find that. All right. Good news, guys. I upgraded to YouTube Premium, so we won't have to look at commercials anymore when I share a YouTube video. Yeah, let me take my earpiece off. You guys will be able to hear it if I don't. You guys can see the screen, I'm sure now. Okay. Last year, there was a buyer, let's call him Tom, who was pre-approved for $400,000 on a single family house. He was going to put a 20% down payment, and his loan officer told him that the interest rate that he'd be paying was somewhere around 3%. So Tom was extremely happy because it was only going to cost him about $1,652 for principal and interest on a 30-year mortgage. So then Tom went out there and started looking for all types of houses within his range. But unfortunately, he got outbid on every single house and wasn't able to buy anything until now. But the good news is that the same house that Tom wanted to buy for about $400,000 is now going to cost him around $360,000. So great news for Tom, right? Yeah. So then he goes back to his loan officer and he says, I need to get a pre-approval letter for this house. But unfortunately now the loan officer says, well, you no longer can afford this house. And Tom is asking himself, but why? You told me I was pre-approved for $400,000. Now I found a house that's $360,000. And why is it that I can't buy it? He said, the reason why is because when I pre-approved you, the interest rate was 3%. Now interest rates are 7%. So Tom says, but wait a minute, how much more could it be if it's a much cheaper house? So check these numbers out. It was going to cost him $1,652 for principal and interest when the house was $400,000. Now it's going to cost them $2,388 for that same house, about 45% more, even though the house price has come down around 8%. Unbelievable, right? Well, unfortunately, that's the story that a lot of people have found themselves in. And most recently, we got the inflation numbers, which surprised everyone because we were expected to have a much higher CPI read than what we actually had. We actually got a 7.7 inflation read, which we all know is probably a bunch of baloney, versus the 7.9%. So let me explain to you what that means. So from this time last year to today, the government's telling us that everything, once you factor it in, including food, shelter, energy, everything is up about 7.7%. Now, we were expected to be about 7.9%, and last month we were at 8.2%, right? Just numbers that the government gives us. But out of that number, shelter, which is considered real estate, is up 6.9%. Now, I know you guys are probably scratching your head and thinking 6.9%. Real estate has gone up a lot more than 6.9%. Yeah, well, they have funny numbers to go about it, but let's just work with their numbers. 6.9% is what it's gone up, but that's not the number that I'm really so concerned about, because we all know, we all experienced it, that housing, if you're renting right now, your rent probably went up 15%, 20%, some people 100% in just the course of 1 year. But what's really staggering is that just month over month from October, just in the month of October, the price of real estate is up 0.8%, which is the most it's ever been up in 32 years. But a lot of people are left wondering, why is it that it's costing more money for shelter, which includes renting and owner's equivalence rent, which basically means if you own your home, it'd be like you renting the home from yourself. So whatever you're paying in your mortgage is what you'd be paying in rent. So needless to say, it encumbers everyone. It's up way more than everything else. And the reason why is because even though housing prices have come down, the cost of owning has gone up so much when you factor in the higher interest rates and higher insurance costs now that not a lot of people are talking about. So when you factor those in, it's unbelievable. Some people are seeing, like the example I gave you earlier, 45% increase in their payments, all the way up to 70% increase in their payments, depending on how big your loan amount is. So now let's talk about that example that I gave earlier with Tom. I didn't just use some hypothetical numbers. The 400,000 number is actually 392 is what the average home price was just in June of this year, which is crazy because now it's 359,000. So it's come down about 8%, not a huge amount. And we're going to talk about how much it could possibly come down and what I think it'll come down towards the end of this video. But before I get to that part, I just want to explain to you that the cost of financing real estate now has gone from an average of a 3% interest rate, which we were at about a year ago, to now it's hovering around 7 and even 7.5% in that range. And it can even go much, much higher. But some people would think to themselves, well, that means that it's costing twice as much to finance a home. Well, not exactly. It depends. There's a lot of factors involved depending on the size of the loan. It could be anywhere between, like I mentioned earlier, 70% to about 40, 50% more that it'll cost you to finance that same home. So a lot of people are finding themselves not being able to afford a home at this point. So they're resulting to renting, right? Renting is always going to be the backup idea, because who would want to buy a house just to figure out a year later, hey, listen, your house is worth 100 grand less. And it could be possible that can happen again. So let's look at some historical information. I found this chart online, which basically shows the affordability of housing over the course of the last 30 years. And right now we are at the lowest affordability for homeowners since we have seen since 1986. Now it's crazy, right? Yeah, we're at an extreme number right now, but we were also at an extreme number just a year or two ago when home affordability was very low because interest rates were in the 2s and 3s, which meant that home prices were also very cheap, and that caused home prices to skyrocket, obviously. So right now, as I show you this chart on the screen right now, you can see that right now we're in an extreme range. Now, in order for us to return to some kind of a normal range, we would have to get interest rates to come down or home prices to come down, or maybe a combination of both. So I'm going to give you some examples right now where we need to be in order to see more of a normalized market. So let's look at that example that we used early on. The payment that Tom was going to have was going to be $1,652 for a $400,000 house, or $392,000 house. Now his payment on a $359,000 house was going to be $2,388. So let's cut it right down the middle and say that the payment should be somewhere around $2,000 for it to be an average payment where we should be, where it's more normalized. In order for us to get down to a $2,000 payment on a monthly basis, we would have to have one of three scenarios. The first scenario we would be looking at is home prices need to come down and we keep the same interest rates. So in order for home prices to give us a $2,000 month mortgage payment, we would need to come down another 15% down to about $300,000 average home sales price across the United States, which is very possible. And I've seen it before in my career that home prices have come down that much. Now, all right, maybe home prices won't come down that much. Maybe some people watching this video think, no, we've already kind of rock bottom. We're going to go stabilize from here. Well, if you're in that camp, then we would have to get interest rates to come down. So right now, currently interest rates are somewhere in the field of 7.5%. So for us to get down to a $2,000 payment on that same $359,000 house, well, we would have to get down to a 5.5% interest rate, which is also very doable if buying yields cooperate with us and those types of things happen. But we don't know. We don't know what could happen. The third scenario is maybe a combination of both. Now, what would happen if we had that option? So for that to happen, we would have to get another 6% drop in home prices, which would bring us down to about 335,000, 330,000 in that range. So that's not horrible, but we would also need to see interest rates come down to about 6% on a 30-year fixed mortgage. That again would bring us into that 2,000 range. But what would happen if interest rates continue to climb up? What if we got the opposite of what we're waiting on? What if interest rates kept going up and we got into the double digits? Well, if that were to happen, guys, I'm telling you, all bets are off. We're going to definitely go lower than 15% on home prices. We might see 25, 35, maybe even 50% home prices dropping, because what's happening right now is that home prices are trying to catch up with affordability, because a home can only be worth what someone's willing to pay for it. And if people continue to slow the roll and not buy homes as quickly as they used to, because there's less demand due to high financing, well, if sellers really want to sell their homes, they're going to have to get more aggressive, and they're going to have to start selling for less and less and less until they hit that point where they owe as much as what the home is worth. So in that case, what they may have to look into is called a short sale. Now, some of you might be familiar with the term, some of you have maybe not are familiar with the term. It's basically asking your short payoff. And in that case, you would ask the bank, hey, bank, listen, I know I owe you 300,000, but the market's kind of weak right now, and it looks like I can only get about 250,000 for the house. So then what's going to happen is the bank's going to send out an appraiser, they're going to value your home, and they're going to say, okay, we've done our analysis, and it looks like your home is worth about 250,000. So in that case, the seller would get a short payoff, and they'd be able to sell their home for 250,000, which means that then they'd walk away. And if all remains the same with all the way the short sales have happened in the past, the seller wouldn't have to pay back that difference, that shortfall, and they would also get an exemption on their taxes for that amount, which means that they wouldn't have to pay that as well. Right now, the exemption is up to $1 million on primary residences. Hey, but that could all change.
All right, so let me just, if you guys want to see the rest of the video, I'll share the link to it in the chat. But
That
I
was
just-
gold.
Yeah, thank you, I appreciate that.
Lots of information.
Thank you, sir. I appreciate that. It took me some time to prepare it, but I want to respect your time, guys, and also want to give you the opportunity to ask questions if you have any questions that came up either from the video or from anything that we spoke about today.
I have a quick question. When you asked everybody if we saw the reports, where is it that you're looking on a daily or weekly basis? What is it that you're watching?
Good question. So I'm really into finance. So there's this website that I found here. This is the best one that I've found so far because it's not like a political one mixed in with also financial information. It's all financial information. It's called forexfactory.com. So in forexfactory.com, it looks like this when you open it up. But up here, around the top, you get the news, which is all business news, and it's highlighted here. Like anything in red has a big impact on the market. Anything highlighted in yellow has a moderate impact on the market, and anything that's just gray is just news. You also have calendar here. The calendar I really like because the calendar will give you news that's going to affect the market. I'm sorry, the calendar gives you reports that could have a big swing on the market, such as last week when we had the housing numbers, which were here, right here. Or is that US? You got to scroll down to US. Or wasn't? I think we passed it. It's core retail sales 17. Housing market index US.
While you're looking for
How's
that, I
this?
got
Right-
a little
right here.
joke for you.
Here it is. Sorry, guys. Building permits. It was on November 17th. Building permits, housing starts, and a whole bunch of other stuff that you would need information on. Same thing here. If it has a big impact on the market, it's usually in red. If it doesn't, then it's like yellow or just faded out. And this week, what we had to look forward to is the Fed minutes are going to be released this week. So we basically get to hear what was talked about at the Fed, because 2 weeks ago we got the CPI number. Well, no, the Fed interest rate decision, I think, was like 2 weeks ago or 3 weeks ago. But now we get to hear what they actually spoke about. So we get to see what the tone was of the meeting. We get to see if anybody said anything outlandish that kind of makes us think that, hey, there's some craziness about to happen. And I think that's going to be released, let's see, here on the 23rd at 2 p.m. FOMC meeting minutes. So this is what I look at. So to answer your question, this is what I look at. And what I like about it is that if you're a newbie and you don't understand what this stuff is, you just click right here and it tells you what it is and how it impacts the market. So it says here, it's a detailed record of the FOMC's most recent meeting, providing an in-depth insights into the economic and financial conditions that influence their vote on where to set interest rates. And then it gives you related articles here, which is really cool. And it gives you the history of the other ones. So cool. It's a cool website for you guys to look into. Let me put it in the chat as well with the other stuff there. And then
Thank you. And I'm laughing because I've only looked at it to figure out which pair I'm getting ready to trade.
Oh, that's all you
I
look at?
never, yes, I never opened up and I never looked to see what the news is. I just want to know what banks are closed, what banks are open, and who got news today, because that tells me what pairs to trade.
That's a
So,
great website. Yeah, I love it. Okay, cool. I posted that in there as well. Awesome. Any other questions, guys? Good questions today too. Good stuff.
Louis, when is your course gonna start?
So now that the studio is done, I'm gonna put the finishing touches on it. I think it'll be ready to be released tail end of this month, if not the beginning of next month. What Sarah's referring to is that I've been touting a real estate investors course for the last few months. And when I actually got down to the meat and potatoes of it, I want it to be an evergreen course, which evergreen course basically means that it'll be just as valid today as it will be 2-3 years from now. So what I've noticed is that over the years, certain things have worked for a period of time and certain things work for another period of time, but they don't always work all the time. And the only thing that I've noticed that has always worked have been auctions. So what I did was I created the course around my auction experience, both in person, live foreclosure auctions at the counties, and also online auctions, which I've had the pleasure of being very well informed on how those work as well. And so the course I'm creating, which is going to encompass how to get your foot in the door with auctions, whether it's for you or whether it's for your clients. If you want to use this as a tool to get inventory for your clients, I've done it all before. So that course will be ready, and by the beginning of December, it'll definitely be ready. If you guys are interested in it, obviously I have a discount for all of you who are already agents with us. But it's going to be something that I believe will benefit you if you guys are, well, you should, everyone should get into the mindset of right now looking to see where investments are going to be. And there's going to be a lot of them coming up because the way the market's going right now, things are due for a change. Thank you.
I'd like to add something.
Yeah, go for
it. The course.
Yeah.
Oh, that's how I started my career. A couple of years ago with auctions, and I did pretty well. Whatever you teach me, it was way worth it.
Yeah.
So yeah, I mean, I think it's a great idea. It's coming back because it was like saturated already. So now it started to come back. So we should be ready to buy or to buy for others. Yeah.
Exactly. Guys, we made so much money representing clients for sheriff sales. It was ridiculous how well we would do. And I was shocked. I mean, really, to be honest with you, how many people would come in and just hand us over 50,000, 60,000 in checks and say, here, go to the auction for me. It'd be surprised how many people are willing to allow you to do that.
Wow. Louis, is the course going to be like a recording or live training or?
Yeah, so because I can't teach everybody the fundamentals because I'll go crazy. So the course is basically to teach you the fundamentals so you understand the language, the technicals, you understand how to get from like point A to point like, I don't know, R. And then once you have that understanding, we'll have a monthly a meetup call, kind of like this, but on a monthly basis, where we can get more technical, like super specific technical on certain situations, because I know that not every situation is going to be the same. So I can't make a video on every little thing that could ever happen. So we'll cover those in a monthly chat as well, for specifically just for investment purposes, not for like real estate sales and things like that. Even though you can ask me about sales in sheriff sales for your clients, those are different, but it's not going to be about like how to get a listing. You know, it's not going to be anything like that.
Yeah, Louis,
yes, sir.
A question for you. Do you foresee a foreclosure tsunami that the social media is talking about in the coming months? For a course like the one you're talking about will be even more relevant. What made you? Yeah.
Nothing is out of the question, because the reason I tell you this is because inflation is not something to joke around with, because if right now, if you got, people don't realize this, but inflation is 400% what it should be. So if that continues, the Fed has to get very aggressive. And the more aggressive the Fed gets, the deeper and deeper we get into a recession. And the deeper we get into a recession, the higher interest rates go. And that's the way the Fed's going to combat inflation. And if you guys remember in the 80s, Paul Volcker had to raise interest rates to 20%. Not to say that we're gonna get the 20% this year, but even if we get the half of what that was, that's gonna be a humongous impact on the economy. It's gonna be harder to finance real estate. Businesses are gonna lay people off en masse. So once you start seeing that, then we can get a tsunami of foreclosures. But right now, I don't see a tsunami happening this year right now or anything. But 2023 is going to be a very telling year. But like I always said, it's better to be prepared and ready for something, and maybe it doesn't happen, than not be prepared and it happens and you're like, damn, I missed this opportunity. So always be prepared for the worst case scenario for sure. So hopefully that answers your question.
Yeah, yeah. Thank you.
No problem. No problem. Thank you.
Hey Lou, so I'm looking to get back to my testing hustle and cold calling and stuff like that. So I've been doing research and I found a way to check who is have a adjustable mortgage rate this time, homeowners, right?
Oh, nice.
So that's what I'm gonna target right now because they're the one who's suffering at this point and they're gonna keep suffering with the high.
Yeah, because they're gonna jump from a 3% to 7.5. That's nuts. That's great, man.
Yeah, I was on a training on Saturday with Grant Cardone, and he was talking about that 2023, it's gonna be a year that all the people that got the adjustable mortgage, they will be selling.
Mm-hmm. Yeah. Once more inventory hits the market, guys, we're gonna start to see a whole nother market that we haven't seen in a while. It's about time for it to be. It's due because the recession we should have had in the COVID time, it's being pushed, has been pushed off, and we're gonna pay the piper, I feel, to an extent. We'll see how long it goes for. Awesome. Well, great meeting, guys. Thank you so much for being here. And if no one has any other questions, we'll go ahead and close out with our prayer. Good. All right. Father God, we thank you for having us here today, Father. We thank you for all the blessings in our life. And we ask you, Father, also to forgive our sins, Father, for anything that we have done that does not serve you or serve ourselves or our family. Father, we ask you to always bless us with more intellect, Father, and just give us confidence in everything we do, because we know that everything we do with you, Father, and for your grace. Father, we ask you to protect our families and protect our health and allow us to become better versions of ourselves every day. And we ask you to please bring us back here in one piece next Monday. Father, in Jesus' name we pray. Amen.
Amen.
Thank you, guys. Have an amazing day. Thank you for everything.
Thank you. Have
Thank
a
you.
nice day,
Have a
everyone.
good day, everyone.
Thank
Have a
you,
good
Louis.
holiday.
Thank you, guys.
Thanks, guys.
Thank
Bye.
you, Louis.
No problem, guys. Take care. Be good. Bye-bye.